Today, we are tearing into a really significant forecast report, one that's focused entirely on PUIT Technologies. And we're going to try and answer the one big question that seems to be on everyone's mind. Can this company, PUIT Technologies, actually hit that $10 mark by 2026? That's our mission today. Now, the report we're looking at suggests, yeah, it's viable, but, and this is a big but, the whole thing really hinges on two major market breakthroughs. Just for context, as we're talking, the stock is kind of coiling around $6.81. So that $10 target, that's about a 47% upside from here. A huge move.
It's a massive move. And, the entire forecast, the whole journey to $10, it all boils down to one fundamental pivot.
Okay, what's that?
The company has to flawlessly transition from what it's always been, this R&D/design company, into the mass production phase. Mass production. And specifically for AI data centers, that transition is the rocket fuel. Without it, this whole story it doesn't get off the ground.
All right, so if that's the fuel, let's start with the launch pad. How is Wall Street feeling about this right now? I mean, are they buying into this story?
The temperature is definitely warming up. The report makes it really clear that the sentiment has shifted in a big way. We're now looking at a consensus rating of strong buy.
A strong buy. What does that break down to?
It's 2 buys and, importantly, 0 sells.
0 sells. Okay, that's telling. It suggests nobody, at least no major firm, is betting on a total collapse. They just see execution risk.
Precisely. The risk isn't that the tech is fake, it's whether they can actually build it at scale. And you see that caution reflected in the price targets.
Right.
So the street low, your floor, is about $5.50. The average target is sitting right around $7.80.
$7.80. And the highs?
The high is just a little over $8, maybe a touch more. So you can see they're still being pretty conservative.
But that average of $7.80 is interesting because they've been moving that number up, haven't they?
They have, and that's a key tell. These targets were just revised up by about 15% in December. Analysts don't just do that on a whim. That signals growing confidence.
Okay, so their confidence is growing, but they're still capping it around $8. How do we get from $8 to the $10 or even $12 the report talks about?
That's what the report calls the blue sky scenario, the bull case. The average target is based on, let's say, good execution. The blue sky target is based on perfect execution hitting a very specific market window.
Perfect execution. Let's talk about what that looks like. We need to get into the catalyst now, the actual rocket fuel, as you called it. What's number one?
It's a number that's going to sound almost unbelievable: explosive revenue growth.
Go on.
Analysts are projecting what they call a hockey stick curve. They're forecasting revenue growth of over 2,000% in fiscal year 2026.
Wait, hold on. 2,000%. I mean, come on. That number just screams high risk, right? How can any company scale that fast?
Well, that's the thing. It's only possible because they're going from basically 0 commercial volume selling, small R&D samples to high volume components for data centers.
So it's a jump from near 0 to something substantial.
Exactly. Investors aren't buying the company on 2024's numbers. They're buying it purely on the anticipation of that 2026 ramp. And look, even if they only hit, say, 70% of that projection, the re-rating still happens.
And that ramp, that 2,000% number, it's all tied to the second catalyst, which is the AI pivot. Explain that.
Right. It's all about their core tech, the optical interposer.
In simple terms.
Think of it like a super efficient highway interchange for data. Instead of slow, hot, power-hungry electrical signals, it allows data to move as light, much faster, much cooler.
And that's critical for
800G and the coming 1.6T speeds, and this is the key. Every single AI cluster being built, whether it's using NVIDIA or AMD chips, is hitting a bottleneck. They can't move data between the GPUs fast enough.
So PUIT's tech potentially solves that bottleneck.
It's one of the most promising solutions. That makes it essential hardware in this massive data center arms race.
Okay, so we have the incredible growth target. We have the tech aimed at the hottest market on the planet. But there's always a third piece with these companies, isn't there? Cash.
You absolutely nailed it. The fear of dilution. And that's why the report flags the capital raises from back in December 2025 as so critical. Management secured over $90 million in cash.
Why was that timing so important?
Because a production ramp-up is messy and it is incredibly expensive. That $90 million buys them time and focus. They don't have to go back to the market, cap in hand, right when they need to be 100% focused on manufacturing.
It takes the bankruptcy or the dilution fear off the table.
For the immediate future, yes. It was a huge de-risking event and it gave them the runway they needed to pull this off.
Okay, so the fundamentals seem to be aligning. Let's shift gears. For anyone interested in the market mechanics, let's look at the chart. What are the technicals telling us around this 680 level?
The chart is coiling. That's the best word for it. It's a classic consolidation pattern, usually before a really big move one way or the other.
So let's define the boundaries of that coil. Let's start with a floor. Where is that key support level, the launch pad, that has to hold?
It's a very tight zone. The report identifies it as between $6.50 and $6.65.
$6.50.
Holding above $6.50 is, let's call it non-negotiable for the bull case.
Yeah.
That's your buy the dip zone. If it breaks below that decisively, the technical picture gets very ugly, very fast. You'd likely see a retest of that 550 street low target.
Got it. 650 is the line in the sand. Now, what about the ceiling? The stock has been rejected a few times. Where is that breakout point?
That's the key battleground. It's right between 750 and 780. But the analysis report is, it's laser focused on one specific number.
Which is?
$7.81.
81 cents. Why so specific?
Because remember what the average analyst target is? 780.
Ah, okay. I see.
So a clean daily close above their target
Right.
at 781 is the technical signal. It tells you the market is officially rejecting the conservative Wall Street view and is willing to pay a premium.
And a break of that level opens the path to what's next?
First stop is the 52-week high, which is up at 940. And once you clear that, the path to $10 is wide open.
So that's the bullish roadmap. But we have to be balanced here. For you listening, we need to talk about the bear case. What could blow this whole thing up?
It's one word, really. Execution.
The production ramp.
Exactly. The number one risk is a delay. If they can't get this ramped up successfully by, say, the end of Q1 2026, or if there are quality control issues, the whole thesis is immediately undermined.
And if that happens, the stock goes where?
Straight back down to that street low target of 550. The market has absolutely zero patience for delays in the sector. It would be a sharp, painful sell-off.
Okay, and let's say they do execute. The report mentions something about volatility. This isn't going to be a smooth ride-up, is it?
Not at all. The report points out an implied volatility rank of around 92%.
92. What does that actually mean for someone holding the stock?
It means this is not for the faint of heart. Not for weak hands, as they say. You have to expect wild price swings. 5 to 10% moves in a single day, up or down, will be normal. That's just the price of admission for this kind of potential upside.
Intriguing. You don't get a shot at 47% gains without some serious bumps along the way. Okay, so let's synthesize all of this. Yeah. What is the final viable path to $10, according to this analysis?
It's a three-legged stool. First, fundamentally, they have to nail that transition to mass production for the AI market. Second, financially, they have to use that $90 million runway effectively.
And
third, technically, the market needs to confirm the momentum by breaking and holding above that 781 resistance level.
We've established that Wall Street is still being cautious with that $8 target. They're reactive, right? They wait for proof.
They're always reactive. They have to be. They can't put a $12 target on a stock based on a promise. They need to see confirmed purchase orders.
And that actually leads us perfectly to the final, and I think most provocative point the report made. Something for you to really think about.
Right. The report posed a specific scenario. What happens if, in Q1 2026, POIT announces they've signed a major deal with a Tier 1 partner? The kind of deal everyone is waiting for.
No doubt.
The analysts won't just nudge their targets up to 850 or 9. The analysis suggests they will revise them overnight, probably jumping straight to $12 or maybe even higher.
A sudden massive re-rating.
Exactly. So think about what that implies. The market knows the potential value could be $12, but it's only willing to price the stock at, 7 or 8 until it sees that final concrete proof.
That gap between today's price and that $12 potential, that's the execution risk premium you're paying for. The whole market is just waiting for that 781 trigger to signal that the risk is finally coming off the table.
And that is the deep dive you needed.
Until next time, keep digging.